So Shanghhaipreneur on Leo Finance had this really interesting article talking about traditional markets moving against you while you sleep. And his whole point was that, according to this CCN article, that most of the gains over the last 20 years have come from overnight moves rather than intraday moves. And that sounded odd to me because, if that were such a reliable pattern, then that's what everybody would trade. So, and the answer turns out to be, interesting. So if you click on the link, it goes to the CCN article, and they cite a tweet from with this chart. Where did it go? From Rich Kleinbauer. And so I wanted to take a look at this. So what I did was I went to Yahoo, and I downloaded the S&P history with the same time period, 1993, I extended it to 2020, but starting in 1993. So that same point here. And I wanted to look at what was going on. So I actually ended up downloading the SPX, which is the actual index rather than the SPY, because the Yahoo's data on the SPY is messed up somehow. So yeah, but the actual index should be fine. So I did a couple different analyses on it, and so the first off was that if you went back to 1993 and you just took $10,000 and you just bought the index and then held, today you would have $69,000. So about a 7 times increase. And if we go back to that chart that they had in the tweet, well, that's a 600% gain over that time. So that's pretty close. 600 versus 600 versus 700%. So we are in the ballpark. And then I said, well, if that's the case, then I should be able to just buy the close and sell at the open. And if you just do that just every day, you end up with, starting with $10,000, you end up with $12,000 or almost $13,000. So that's kind of not great. So I did a couple more variants, and fundamentally what we're looking at is gap trading. So I did a count of how many gaps are we getting from just a cumulative count. So starting in 1993 we got a fair amount of gaps. By the time we hit 1995 we're up to 222 there. So that, there's about 250 trading days. So that's about every other day. And then it just dies from 95 to 2006. So gaps just stopped happening. I'm not entirely sure why. And then 2006, they started happening again. So now if we go to the gap count in 2006, there we go. So let's say just, keep dates even. So we started at 385 at the beginning of July 2006. And then we end up with 3,685. So that's like 3,000 gaps in however many days that is. So let's just count however many trading sessions that is. Too far. Okay. So 3,500 trading sessions, and we got about 3,000 gaps. So that is now the vast majority of the time we're getting gaps. And there was this lull in that period just in 2012. So pretty much we're gapping all the time. Okay, so that's all great and everything. So, but even if you zoom in on this chart, which I've done, and you look at the sell to open, then it just doesn't keep track. So I'm not entirely sure how they derived that chart that they had in the tweet, but they're doing something else, I think. So I did a couple other tests. So one was that, okay, if just buying the close and selling the open doesn't really work, or at least doesn't work great, what if we add a moving average? So so then what I did was, okay, if we're above the moving average on, at the close, then we buy, and if we're below the moving average at the close, we short. And that doesn't work great either. So that only ends up at 11,000 or so. So that actually underperforms just the straight selling and buying open. So I was very confused by all this. So next, what I looked at was just the intraday. So I was looking at the opposite side of that chart. So I was looking at this part now. And I go ahead and say, okay, if you start with $10,000 and you just buy at the open, sell at the close, no matter what, how does that end up? And over however many years it's been, 27 years, you end up flat. So that is a little bit crazy if you think about it. So basically, I'm showing that this red part of the regular hours chart is more or less I agree with. So what that's telling us is that we have some kind of neutralizing force or effect within the intraday. So my next step was, okay, let's add the moving average. Let's say if we are above trend, if we're above the 10-day moving average, and I played with 20-day and 10-day, but 10-day works fine. If we're above, then, or if we closed above it yesterday, then we go long today. And that actually ended up not working. So you can see that here. So if you do it that way, then you end up with actually $1,100. So you actually lost 90% or 88%, whatever, of your bankroll over that time. But that's actually good news, because if we have a directional bias, then we just have to figure out which way. So if yesterday was above the moving average and we go along today, doesn't work, then let's do the opposite. If yesterday was below the moving average, then we buy. And if yesterday was above, then we short. Very simple. So that's just adding a knot here. Oops, if I can find the right place. There. So now, by going opposite of that, we end up with 36,000, which is almost exactly half of just going a simple long. So, that's interesting. And the other interesting part about that is that, the drawdowns, except for this last little bit, has been very, relatively smooth. So we can see here that this really starts to take off in the 2006 period, and that's matching with our gap count. So there was a regime change basically in trading around 2006, which I hadn't really realized before, but this kind of analysis is bringing that to light. So so that worked up until whatever it was, 2017, and then it's now working less. So again, something has changed in the just overall market somewhere around 2017 there. And it might be worth looking at there, that the strategy is now flipped on its head. So maybe it's worth now going long if yesterday was above the moving average. So like increasing trendiness rather than counter trend. And I don't know the reason for that, but like if you were doing this on an options basis, then your equity curve would be much higher, and your drawdowns would also be low, would also be more severe. But I think the overall upswings would would work for you. And of course, if we look here, this is just the simple long equity curve. Let's go ahead and actually just put those side by side. So we got the date versus the simple long, and versus intraday analysis. We insert a line graph. Let's move that to chart 4. And now you can see that we had the dot-com boom and crash, and we had the financial crisis, or culminating in the financial crisis, the subprime, whatever you want to call it, this leg, and then the crash. But then it's right around here. So at 2000. Well, here it's looking more like 2005, but really in 2006 it started getting going, and you can see that the intraday, at least during this regime, was a really big factor. The curves were matching pretty well, and then they started to diverge, and now since I guess here we can see a little bit better. Yeah, about 2017, they started going the other way. But now we're back in correlation here, which is interesting. With the COVID crash. What to make of this? I think under the current regime of trading, the intraday long short seems to be worth investigating. Anyway, so I could not confirm this chart working out exactly how they were talking about it. I think there might be a data problem in there. Also, I don't know where the original article is, so I don't know what kind of methodology they were using. But it is worth noting that there are these different market regimes in these different time periods, but and you have to kind of trade accordingly. So anyway, it is 5 a.m. So I think I'll give it a stop here, and we'll see what we see in the coming days.